Welcome to Investors Insights. Our topic today is pullbacks. Interesting word, a word that we continue to read about and see in analysis. What does that mean to you as our clients? Pullbacks. I'm joined by my distinguished colleagues, as I like to call them, Trey Booth, Bobby Norman, and Ty Miller. And we're going to talk about that word pullbacks in different topics and categories. So to start off with, Trey, talk about the point you made about pullbacks and gasoline prices and oil rigs. It's something that has a rippling effect in our economy and can ultimately have it in our markets.
Absolutely. Thanks, Greg. So last week marked the 10th consecutive week where the rig count in the U.S. didn't go up. In fact, it's decreased or pulled back. So the total rigs in the U.S. is now 106 off of its all-time high. And why is that important? Well, this next chart shows that we've seen an increase in the price of gas at the pump over the summer. And with that rig count continuing to fall, it makes it unlikely that U.S. oil producers will be ramping up production to cause that price to fall. What we often want to see is when prices rise, that incentivizes production, which then eventually brings prices down. But you need rigs to produce more oil. And so seeing the pullback in oil rig count is concerning that we may see that this price of gas may continue to rise or at least stay at elevated levels. And we're seeing that flow through directly to the market when you compare consumer discretionary stocks versus oil stocks. So this chart here shows the relative performance of consumer discretionary stocks versus energy stocks. You can see that the July CPI print, when inflation printed at 3%, to that point in the year, consumer stocks have greatly outperformed energy stocks. Since then, oil prices have skyrocketed above $80 a barrel, and we've seen all that gain reverse. So the consumer, what that's saying is the market is expecting consumer to have to start pick between, do I fill up my tank or do I get to spend on this discretionary good? And the market's expecting that the consumer is going to have to fill up the tank. And so that's seeing consumer stocks go down. So something we're watching very closely is how this pullback in oil rigs bleeds all the way through to consumer stocks and how that impacts the market. So something we're watching closely.
Yeah, and I always love that kind of information, and especially sharing it with our clients and viewers of the blog, because it does have a rippling effect. Things take place over here, and ultimately they can have an impact in other areas. And so I really appreciate the way you condensed that and brought that topic to light. And then that led to where Bobby said, well, let's talk about pullbacks. Bobby, continue the discussion we've had about September, also historical data and pullbacks.
Yeah, we had some great feedback and conversation with viewers of the vlog last week, specifically tied to what Trey talked about in terms of the markets being historically volatile in the month of September. And as Trey covered, September is historically the worst month for the markets, but every time period is different. And one thing I want to cover today is that intra-year pullbacks in the market are completely normal. It doesn't necessarily mean the markets will be down after September. So while technical evidence kind of supports the case for the potential for a longer-term bull market trend, investors should expect some pullbacks along the way. And to show this, I want to share this chart. It compares intra-year price performance and maximal pullbacks for the S&P 500. So at a high level, the top row of the chart shows that even years with double-digit gains into August often experience sizable pullbacks over the remainder of the year. On the right of the first column there, you can see that going back to 1950, the average pullback of the S&P 500 has been down 8.6%. But the final average return for the last 6 months has been up 5.2. To break down the data further, the quintile ranked the performance of the S&P 500 from December 31st to July 31st. You can see in the chart there for each year going back to 1950. We then analyzed the corresponding average returns in the middle column, seen in the chart, the maximum pullbacks for the remainder of the year for each quintile group on the far right column there on the chart. As always, no guarantees, but as the chart shows, even good years have historically seen pullbacks at times throughout the year, completely normal for the markets to experience. We, as investment advisors, we use this data to take advantage of market pullbacks when opportunities present themselves.
That's well said, because, as you said, pullbacks could be a buying opportunity, and they can be healthy for a market. Folks, don't panic, don't worry with the volatility. There's opportunities there. It's all in how you research it and look at it in relation to your financial blueprint. And then Ty, you talked about pullbacks in regards to jobs and unemployment and small business. So how all of that data works in relation to pullbacks. So elaborate on that.
Yeah, we got the August employment report a couple weeks ago, and so non-farm payrolls increased 187,000, beat expectations by a little bit. Private sector was up as well. Specifically, the education and health services, as you can imagine, with school starting back, and leisure and hospitality. We did have a little decline in the truck transportation industry because one of the major players there dissolved. But overall, a really solid report. One of the headlines that you'll see that may be a little confusing is that the unemployment rate rose to 3.8% from 3.5%. And so you think, that's probably not great. However, all of that gain in the unemployment rate was due to an increase in the labor force. Now, the labor force is people that are either actively looking for jobs or working. And so 736,000 more people entered the labor force this past month. And that's a big deal because since COVID, we've really lacked in the labor force participation. We've had a lot of people just for whatever reason, early retirees, stimulus from the economy and whatnot, and stimulus from the government and whatnot, increased savings. People have kind of, left the workforce. And so it's nice to see that this is the highest labor force participation we've had since COVID happened. I know that hasn't dealt with pullbacks yet, but I promise I'm getting there. If you look back at the what we've seen so far year to date, one interesting point of the job market is that small businesses, this is businesses with under 500 employees, have made up 100% of the job growth year to date, as you can see in this chart here. So big businesses are pulling back on their employment while small businesses are adding to it. That's very interesting, but we're starting to see small business hiring start to slow down here. And, one reason for that and one reason we want to keep an eye on that is the IRS is starting to pull back on the business tax refunds they're giving out specifically for mainly small businesses. They, of course, had the employee retention tax credit this year, and now the IRS is starting to take these claims a little more seriously, I suppose is the word. They're looking for falsified claims. They're trying to make sure that everything's legit, and they're trying to, kind of cut back on what they're giving as they're seeing this, very good, healthy job market that's kind of led us throughout the year. As you can see in this chart, business tax refunds were way up, and now they've come back to a more normalized level. And it's going to be interesting to see how the job market kind of continues from here.
And with less than 4 months left in the year, it's going to be interesting to see how all this data comes together as we navigate through the volatile markets and see how these pullbacks have a rippling effect. But we're going to watch it closely. And we're also going to continue to be doing these vlogs, having one-on-one conversations with you, telephone conversations. Also, don't forget about our social media. We take great pride in what we do on LinkedIn, Twitter, Facebook, also our podcast, our YouTube. We are wanting to constantly bring information like this to you so that when the news picks up on it, you're already prepared and understand that, well, the market may be volatile, but in relation to my portfolio, in relation to my financial blueprint, I'm fine. And don't hesitate ever to call us or email. I also just want to say thank you. And I think each of us can show our appreciation because several of you continue to forward this to colleagues and neighbors and friends, family. And it's a huge compliment when we get a call from somebody saying, I've been watching your vlogs and it's really helped me understand what I need to be doing and I need to have further discussion with you, or I need a financial blueprint as well. That's a huge compliment to us. So on that note, we will keep you updated. We hope you have a great week. We thank you for watching, and please know every day at Five Plan Partners, we're striving to see to it that our clients have a better, richer, fuller life. Take care and talk soon. Thanks.